Ladies and gentlemen, please welcome back Craig Wolf.
Thank you. All right. I know some people are still trying to get seated here, so give them a second here. So we've saved the best for last, in my opinion, here at the U.S. Beverage Alcohol Forum. We're excited to have the top minds in the finance world, as it touches on beverage alcohol, with us here this afternoon to talk about raising money to start and grow a brand, as well as to how to position your brands to sell at the highest price point possible. We just had an interesting brand battle. We talked about a lot of different issues about, how your brand, should be presented. What's the story? What's the taste? How do you formulate all these things? But I'll tell you one thing: no matter how good your brand is, you don't go anywhere without any money, right? You still got to have money. You've got to get started. You have the financing to do it. And the gentlemen we have coming to speak today are some of the best in the business. So first up, we have with us Bill Anderson, founder and CEO of First Beverage. Bill, come on out and tell us a little bit about you and your company.
First of all, thank you very much for the invite.
Can we get a speaker going here? Is a microphone going, please?
Thank you for the invite to be here. I was lucky to grow up in a beverage distribution family. My family has wine and spirits and beer distributorships across the country, and so I got beverages in my bones early. And when I left my family business, I wanted to sort of scratch my entrepreneurial itch, and I saw that there was no financial services firm just dedicated to the U.S. beverage industry. And you could see this dynamic shift happening away from some of the mainstream brands to more artisanal and authentic brands when I started this. So First Beverage today includes both a private equity fund and an investment banking arm. Our private equity fund is invested in brands like Drizzly, and we most recently made an investment in Q Drinks, the artisanal carbonated mixer. And our investment banking group has been very busy, most recently selling craft beers. We've sold over 10 craft breweries in the last 3 years, but we've also been very active in the distribution space. One of the keys for me in putting together First Beverage has been attracting the right beverage people along with the right Wall Street experts. I'm lucky to have Jim Bareither, the former COO of Brown-Forman, as my board chair, and also to have John McDonald as the chair of my advisory board. And both of them have been past presidents of Discus and have been great advisors and mentors to our portfolio companies and to our clients.
You could do a lot worse. You could do a lot worse than Jim and John, obviously. Our next panelist is Todd Martin, founder of Spirits Capital Partners. Todd, can you come on out? Tell us a little bit about yourself and your background and your company.
Well, first of all, thank you for inviting me. It's great to be here. It's a lot of fun. I'm out of practice on panels. The last one I was on was 15 years ago with Ivan Menzies in Scotch whiskey. Spirits Capital Partners is a partnership that I formed 18 months ago to identify the next hot brands. And I guess if you have to put a magnitude on that, it'd be brands with the potential to be $100 million in value or higher. We are a hybrid company in that we provide expertise and get involved in the operations of the company as well as providing capital. So we're not a private equity or venture capital fund, but we have partners who are, and then I personally get involved. Now, my background is I used to run Allied Domecq, first as CMO worldwide and then North America. And then I started a spirits company and co-created a brand called X-Rated Fusion Liqueur that was pretty successful, and Campari bought it from us 3 years after launch. And then I set up a family office, and 18 months ago decided that the spirits industry had a lot of entrepreneurs, great talent, and in fact, this is the most innovative period, I believe, in spirits industry history. And that I would launch a company to identify the highest potential new spirits brands and their great entrepreneurs behind them, and then help them achieve the dreams and potential that they've set out for themselves and have a lot of fun doing it. So that's what we're all about.
Great. Well, thank you. Welcome. And our third and final panelist is Jeff Menashe, founder and CEO of the Demeter Group. Jeff, come on. And the same thing, Jeff, tell us a little bit about yourself and your company.
Sure, thanks. As the other two said, thanks for the invite. DeMita Group's an investment bank that whose origins are on the buy side and in consumer broadly, so food, beverage, and beauty. The last 4 or 5 years, though, really have focused exclusively in wine and spirits, as well as the beauty space. A lot of similarities between the two. Our origins, being on the buy side, were for Nestle, Clorox, Del Monte, family offices in the space, where we helped them figure out how to deploy capital, reaching down in the mid-market and getting a hold of innovation, sort of in a high-growth brand concept. So looking at structures from licensing, JVs, through minority investments with a path to minority investments with no path and outright acquisition. So
very good.
That's DeMita.
Very good. Thank you. All right, so we're going to divide this discussion up into several sections. We're going to have some general questions to help people understand the framework we're talking about here and some of the issues going on. And then we're going to talk about different phases of the business. Okay, so starting out, we've heard that investment money was easier to come by a few years ago. In the tech world, certainly, and they've scaled back recently. I think there was a Wall Street Journal piece just the other day that I was interested in reading as well. Have you seen the same reaction with investments in the alcohol industry, and how much influence does one industry, such as tech investing, have over investing in another type of industry? Why don't we start with you, Bill?
Yeah, I don't think it has had any impact at all, and I think it's a great thing for what the three of us are doing up here. I think craft spirits, craft beer are got to be among the hottest M&A categories you could imagine. And I think we're at the early innings in both of those categories. I also think what's very healthy about this period we're in now is there's a wide diversity of buyers and investors. Todd's a perfect example of that. Family offices are investing in craft breweries and craft spirits. There are international strategics, there are international family offices. And you're seeing, even in the non-alc space, you're seeing food companies coming into the non-alc beverage space. So the pool of buyers and investors, I think, in the beverage segment overall has just gotten wider and more diversified.
Todd?
I've had exactly the same experience. I just come back from having a series of meetings with family offices on raising capital for one of our partnerships. And the comments that I get back is, wow, those multiples are high. That's the first thing. The second thing is like unbelievable how you can make so much money in spirits. And the third comment is how do I know that this one is going to be the one that's going to succeed? And so you have a mixture of knowing that their returns are possible and lots of examples of those great exits. But the question they have is if we invest in this one or your fund, then what are the chances of success? So those.
Before I get to Jeff, what do you tell them when they ask that question?
What
do you tell them when they ask that question?
Well,
is this the one?
I started this 18 months ago, and the one that I just brought to market, I joined the board and wrote a large six-figure check when I joined the company a year ago. And so I said, I've been working with this company for a year and joined the board. There's some other really good people on the board. John Esposito, the name may mean something to some of you folks. John Scully may mean something to some of you folks. And I've looked at over 100 companies, and this company, in my judgment, has, and for these reasons, have the chances of success that are worth bringing it to you for investing. And I wouldn't have done that if I wasn't highly confident in doing it. And then they meet the CEO, and we have conference calls, and then
Gotcha.
People are in. Yeah.
Okay, and Jeff? Same question?
As I said, our origins are kind of consumer broadly. So thinking about the consumer landscape, there are waves when sort of innovation is helping sort of reset brands that are resonating with both the consumers and the trade. And I think wine was several years ahead of beer. Beer has certainly been experiencing unprecedented M&A activity the last 2 years. It's sort of a catch-up on 20 years. Spirits, there's been innovation the last 8 years, but I think generally it's at a moment where there is the openness for people to bring capital into it, and it's, I think, going to have to be a solution that's solved for by private individuals that probably are from the industry and understand it. I think there are a lot of other folks that are looking at it because it's in the consumer space, it really is probably one of the 2 or 3 places to be paying attention to, given the growth and sustainability behind it, but in the sort of the stage of development. But I think it's a tough space for people to get their head around.
Okay. Now, just to sort of frame the terms, we've heard about private equity firms, we've heard about venture capital firms, investment banks. You've mentioned some of these already. So, what's the differences? How do you sort of define those different entities, and in terms of how they invest in and why they invest in this industry, and in what way?
Well, I'd start by saying banks. If you want to sort of create those three buckets, banks probably aren't making investments as principals. Okay. So investment banks are advisory firms.
Okay.
And then within that, they can have different specialties. So it could be, they can help you raise capital, they can help you sell, they could be on the buy side. As I said, our origins are buy side, and then we're focused on sell side. We don't do private placements anymore. But VC, private equity, VC is much earlier stage, essentially pre-proof of concept. Okay. And the private equity space, they're going to be looking for a host of characteristics, but they probably generally will define them as past proof of concept will be then tied to a proxy around cash flow. So you're going to be finding that mostly 5 to 10 million in EBITDA is what a private equity investor would want to see.
Okay. Do you guys, go ahead, Bill.
I was going to say, I think one of the most interesting categories right now in the beverage space are family offices. And those are the investment offices of very wealthy families that have earned their money and their net worth in one industry and then have dedicated a large pool of capital to make investments across all investing categories. We helped a family get into the Miller Coors distribution network up in Oregon and Washington, a group called Meritage that's been very active. There have been family offices that have made several investments in spirit companies. We sold a craft brewery to a family office. These offices tend to have much longer term investment horizons compared to private equity. And they also often have the look and feel of a family business, which makes it very attractive to many founders who don't want some of the sharp elbows that sometimes comes with private equity and some strategics.
That's probably a point I can expand on a little bit. I think private equity is not, the funds are not going to be investing in any of the companies that were here presenting their spirits brands. They've got much bigger investment sizes. The family offices are the ones who are looking for these sorts of investments that will be superior to the kinds of investments that make it public equity, for example. And some of them are the entrepreneurs themselves evaluating these investments, and other ones are professionals who are doing that on behalf of one or even several family offices. So, and what they like about beverage alcohol, and I only focus on spirits. I should make that clear. I don't do wine spirits is enough for me. Keeps me busy. They think that the kinds of returns that they can get over a multi-year period of time are by far superior to hedge fund returns, which are now in the single digits. And have been that way for the last several years, or even public equities that are really, at bubble levels, and future returns don't look that great. But when you folks build a business, and that business is well architected with good people behind it, then they like that. Right. They like the potential for the long-term returns.
You mentioned spirits, your spirits. So is there a difference in terms of the investment outlook for the spirits versus wine versus beer at this point in time? And given the rise of the craft spirits market or the sequence of it with the wine, the beer, now the spirits?
I think they all go through cycles. I mean, I think right now craft beer is an obvious one because you're seeing 30 to 40% growth rates. And that has drawn the attention of a lot of outside investors. I think wine is a little more difficult because you haven't seen some of those growth rates among many, and there's 7,500 wineries, so I think it's maybe even a little harder.
You think it's saturated, Bill? I mean, do you think it's...
No, I think it's just harder to pick the winners. And I think craft beer will become like that, and I think more and more money will shift to craft spirits. There are 4,200 craft breweries today. There are another 2 every day in America that are coming online. So at some point, it's going to be very hard to find the continuing growth rates that we've seen up to this point in craft beer. But I do think the next cycle will be craft spirits, and you'll see those same growth rates.
So craft spirits is happening now, and it's been enjoying 40 to 50% growth rates, according to the best estimates for the last 3 years consecutively. But it's also going to hit this, how many different kinds of local whiskey, and particularly if those whiskeys really aren't outstanding, because that came up in an earlier panel today. Is that being local is not going to be enough. It's starting to become the issue in beer, and it's definitely going to become an issue in spirits.
But there are different themes across the 3 sectors in terms of how dollars would be put to work or why.
Are you more focused on spirits than
We're
wine?
we're wine and spirits sort of equally. And again, it goes back to we've been focused there since the firm was founded in 2003. We spent time in beer. I had Lagunitas as a private placement client in 2008 and really walked away from that kind of deflated in the sense that people couldn't get excited about the space because they couldn't answer how up is up. And Bill's done a nice job of building an advisory business in that sense. But so we're focused on wine and spirits. But when you put dollars to work and look at what's happening in these spaces, there are different themes at work there. So wine it is a little more certain, but there's a model that's emerged there where you can kind of develop a high growth asset above brand above $20 that could be asset light off of something with some halo. So look at Camus and Maomi or Duckhorn's success with Decoy. That model is something that others are going to be employing for, but to start with the base of assets, there's a big check size needed there. And there probably needs to be money allocated there to build a fine wine platform that really doesn't exist in the space, because those that were active acquirers have gone silent for a variety of reasons, whether it's Hennessy or Crimson or Hess. Right. So that's wine. Beer, there's for me, the investment theme is different than it was 10 years ago. Yeah. Because now the M&A activity that's occurred over the last 26 months is really around a general theme of portfolio building. So as breweries start to look to reach outside or access innovation through M&A, they're going to be looking down to the guys that are 75 and less to find interesting brands to sort of put on. So you'd be making a bet there. Right. But really the big bet's already been made with what's happened over the last 26 months.
Well, I think there's still some big bets. I think what's interesting in beer and then across into the other segments, the strategics are still setting their strategies. A year ago, only Anheuser-Busch really had a set strategy on craft beer. Now you're seeing many of the spirit companies either create their own innovation divisions or M&A groups, and they're setting those strategies going forward to look at craft spirits.
Are they buying or are they creating their own?
Well, they are buying. They're interested in exits, right? So the successful exits, and then there are folks who don't want to exit yet, but there's a line of people that would love for them to buy the company, and some of them have been honored at this convention. But I think that the real issue is in that middle ground, in being able to establish that the concept is attractive. All of the strategics now have got some sort of investment device and investment strategy, all the discus folks. And essentially the deal is that they'll give you a little bit of seed capital in return for you signing a piece of paper that says that they have a right of first refusal on buying your brand. And in some cases, they'll negotiate a formula in advance with you. That has a good side and a bad side. The good side is you've got a small amount of money. Won't get you very far, but it's very helpful. $1 million, $2 million. But the bad news is that you've probably cut your exit value in half, because a right of first refusal is a very potent deterrent and cap on the value of the company. Right. So the optimal way to do it is to prove it out yourself using as little money as possible that you raise through one of these two gentlemen or myself, right. And then just wait until the right time to optimize the exit.
So I do think a number of spirit suppliers are following this model, and it's really the model that Coca-Cola used with Honest Tea, and they used it with Zico coconut water, and a lot have gone down and met with Coca-Cola to sort of understand that model. There are other benefits. I mean, I think they do provide the right amount of capital, they provide a lot of cover in a very crowded world and get you more muscle at the distributor tier and at retail. But to Todd's point, it does sort of cap your upside at the exit.
Gotcha. All right.
And there are variations on how they do it. Sometimes they take you into distribution. I've seen that, not very often, but it has been done. And other times they're there for you on an advisory basis. But don't expect them to call the president of Glazers, Missouri, or something in order to get you some clout, because they won't be doing that.
Right.
In general, I think you have to, having advised a lot of consumer companies on the buy side and around corporate venture and so on, I'm skeptical of it, and particularly in spirits, where it's going from.
So obviously in the audience and throughout the convention, we have a lot of brands in various stages, but starting at the beginning, when they're just bringing out, what do you suggest that people do when they have a great idea? I mean, you talked a little bit about this, but not enough money to turn that idea into reality. So you talked a little bit about this a second ago. So, would you recommend that type of method? Or I mean, we talked a little bit about, some people go to the companies and then they'll get some funding, but then they tie their hands, right? So what do you recommend to them?
That's a very big question. I'd say the first priorities would be focus on your concept and focus on the one or two people who are going to be in your core team who are there with you. And one of those persons should have spirits industry experience if you're doing something in spirits, because the three-tier system is a Byzantine, complex, very subtle enterprise.
Which we all love.
And it is wonderful in every way and has made me a wealthy man. So I'm deeply grateful. But it's if you have that expertise on your team and you've got a great concept, then raise money amongst your, the doctors and lawyers, and wealthy friends that small amounts of money, and then prove it out in some space. Maybe it's Los Angeles, maybe it's, one or two states. And then when you've gotten to that stage, then you'll actually have gone to the stage of having a business plan. You'll have proven out, you'll know a lot more than you do. And then the people who invest more serious money will be a lot more interested. I don't get involved in pre-revenue. I am late stage venture capital, early stage private equity, because there's a lot of work to be done in that very beginning stage that will test your mettle. And part of my screen is how good your mettle, as well as how good your concept.
Jeff?
I think Todd answered it. It's family, and hopefully you have family and friends to be able to go to and get financing. Obviously, the corporate venture is something that's being put forward, but for a number of reasons, I think it makes it difficult.
I'd add to Todd's point. I think it's interesting. I think particularly in spirits, you want to see some spirits DNA on the team, because I think it is, the distribution world is highly concentrated. It's much more complicated than people think. But on the other hand, these brands are not started by people who've been at Coca-Cola for 45 years or, Bacardi for 45 years. They're started by people that really have no idea what they're in for and how tough it's going to be. So I think it has to be that blend of the really passionate, driven entrepreneur who probably doesn't come from beverages, and then they're smart enough to find somebody like Todd or an outside industry exec who can really mentor them and advise them and open some doors. I'll also agree with Todd that I think a lot of the entrepreneurs we see try and get into too many markets too soon, and they're so ecstatic to take an order from a distributor in Iowa, but they don't realize that their consumer doesn't live in Iowa. And they're much better focusing on their one core market where their consumer lives, go very hard in that market, let the industry talk about their success in LA or Miami or Dallas, and then go from there rather than going very wide too soon.
So I actually think you having me and nobody else on the team that has spirits experience, that would be I wouldn't want to invest in that. They need somebody you need to have somebody who has spirits experience on your team, who's a partner in the business. Every day. And somebody who's got talent, because you're going to need it.
I thought you were going to be there every day.
Several times a week, actually. But not in an operational sense that you're going to need. And the focus is like, don't sell something in unless you've got something that's going to sell it out. Because if it doesn't sell out, your distributor is going to say, "Oh, it didn't work." And then it becomes really hard, to reboot.
So when you guys are talking about at your stage of the game, seems to be a little further along. But for somebody that's starting out, you talk about their doctor and lawyer friends, their friends. So how do you attract those investors? What is the selling point for those investors, potential investors?
Well, I think actually in spirits it's easier to get a number of smart business people to want to say, I own a piece of that mezcal or I own a piece of that vodka. And I see it much easier in this category than other categories we work with. But you have to get it. You know, we've seen brands that have gotten very far with only 2 or 3 million of capital, and they've raised it kind of around their country club or around their aunt's table or wherever it might be, but you have to get it, and you have to go out and make a compelling story. But I do think the spirits industry in particular is a much easier raise than some of the categories we see in non-alc, for example.
How much do you need? I mean, and what is the right figure you need to start out and to get to the point where you get that recognition to go to the next level? Jeff?
Overall, I think that for where one should be building a brand based upon the white spaces that exist in the industry and what people could be buying in 5 to 10 years, there's a certain margin profile and there's a pretty embedded cost of what it takes to develop that concept. So for me, if a brand needs to raise more than 8 and really sort of a sweet spot being 5 to 8 million over the length of its ownership while being independent, there's a problem. But to get to start, you know, $1 million, $2 million can get you a long way, probably, you know, get you 18, 30, 24 months into it, and it's really developing that proof of concept, having those data points in a few markets that matter, with accounts that matter.
So depends how unique your concept is. So the more unique the concept, the less money you'll need. Depends if you've got the spirits experience in your team, even if they're only part-time while you're doing your first round, that will get the right kinds of activity to get your brand out there. And it depends on the margin structure. You know, if you've got something where you've created a lot of value and it doesn't cost you that much, so you've got high gross margins, then your cash burn is going to be a lot less. So the kind of people that the good entrepreneurs are focused on, you know, something that's highly desirable, very well focused in its delivery, has cost them a lot less or significantly less to make than it does that people are willing to pay for it, and then they just prove it out. And once you prove it out, then you build infrastructure. Then you start going bigger, and if you need to raise money for that, fine. But you've got then a model and a story and a plan that will justify, people writing you bigger checks.
If you come across something and you see that the owners have put it on a trajectory where they're starting off with gross margins in the 40s, and the story is that they're going to scale to something 60 plus as they get the economy to scale, that's tough. That you're not going to make it.
That's the line.
No, I mean, for me, I like concepts, whether it's high 50s or 60, but the brands that we get interested in, they've kind of got a threshold of 60% gross margin, but they're playing north of there ideally.
Gotcha.
Craig, I would add, I think that other than defining the product, the two most important decisions is who you take money from and how much you take at that very early stage. Too much can be a form of poison and means the company won't act with the discipline that it should be acting with. And too little means their company's going to be in a constant state of raising money and is going to be very distracted instead of being able to go out and focus their time on selling their brand.
So we were also asking about the mistakes that these companies make, and obviously that's one of them. So too much. What other mistakes do you see as they're sort of going up in that first stage they make in terms of trying to raise capital and how attractive they are to investors?
I think
is it in the story, is it in the marketing? What is it?
I think one mistake we've seen, it's only really been in the spirits category, and it's an interesting one, is some of these brands have raised money at too high a valuation too early. Mm-hmm. And then when they go out to seek institutional capital that's going to be based on market comps, these very smart hedge fund guys that came in wanting to own a piece of a tequila or a piece of a vodka are now realizing that they overpaid. And it creates a serious problem when we're trying to come in, bring in a strategic. So actually, the founder thinks he's doing something really, quite smart at the beginning by raising it at a very high valuation, right. But that can create a problem down the road for his first round of investors.
So I agree, but that they don't want to do a down round.
Right.
So they don't want to have to go back to that initial investor group and explain that they...
Right, and you may have very smart money wanting to come in, but then that initial batch of investors doesn't want to take it down round.
So now let's go to sort of the next phase. They've actually established, at least at the lower level, right? And now they want to grow a little bit. So what should they be doing in terms of, again, seeking capital? How should they be positioning themselves to seek capital? What are some of the things they should avoid, the traps that they could fall into at that next stage? Jeff?
So there's kind of a two-edged way that I reply to this. Ideally, you go hire an advisor to walk you through the process. The problem is I'm actually, and why we don't do private placements, a big fan of hiring somebody to do a raise less than 10 million. I think that if you really have a tight grip on the strategy that you're trying to put proceeds to work against, that if you have good legal counsel who's familiar with how these deals work, that's the advisory team. So if it was more than 10 million, or you're going to sell your company, you should hire an advisor. But in something less than that, you should really focus on understanding and telling the brand story and a set of projections where ultimately you're going to explain to somebody how the money's been put into work and how, based upon what you've learned in the past, is going to correlate to returns or performance in the future. And then ultimately that does begin to frame a concept around what are the growth levers in the business and what are the capabilities that are really going to make a difference to this. And that can be helpful when you're starting to look at, if you have alternatives, in terms of going to different groups, and how to prioritize or filter through those groups, assuming that terms and pricing is all kind of the same. Who's actually going to help you achieve that plan?
Todd, what are you looking for? I mean, what are you looking for at that level?
Well, at that point, to me, the concept, the business model, and the plan, and the execution, and then what's been accomplished, what traction has been established, what's been done. That's and the potential, obviously. That's what I'm looking for. For somebody who is raising capital, the best capital to raise is from the same people who put in the capital the first time. If below the 10 million, I'd say that's probably a good demarc. Above that, you probably should get an advisor to help you raise it. But for amounts of 2, 5, up to 10, then it's your original pool going in again at a higher valuation because the company's proven itself to that stage. The plan has gotten better and tighter. Okay, the economics have gotten clearer and less risky, and the roadmap to where are we going and how, what the future years in the pro formas look credible, right? So, and then along the way, the people who put in the money the first round will introduce you to family offices or friends of theirs with even bigger checkbooks, and then those folks will put in money, and that gets you pretty far.
Bill?
Well, I think hopefully by this stage, you've seen proof of concept in certain key markets. You're able to go out and diligence with distributors how this brand is doing. You are going to see how the team has worked together, where the gaps are. You've seen whether they've been disciplined with that initial batch of capital, how they've spent it. Right. And I think you have a better idea how the use of proceeds in the next round should be utilized.
So at that level, you talked about the distribution, right? So what are you looking for in terms of their relationships with distributors? And obviously, it's the wholesalers convention, but so I'm trying to figure out what you're looking for in terms of those relationships, what maybe their geographic scope or perhaps a particular distributor. What are you looking for at that stage to see how developed they are or how they've developed themselves?
I think you can tell right away when you call a distributor whether there's passion in their voice about this little underdog brand that they've taken on. I mean, at the end of the day, you want to get these major distributors to give you more mind share for your small brand than you deserve. And I think distributors in many ways want that. They want to get behind these brands. They want this to be the next Tito's. And when we call them as part of our due diligence, you can hear it, whether they really see it moving in their markets or not.
Right, and they'll be very honest about it. I mean, it's the distributors are investing in you. They're just investing a different sort of capital. Sometimes it's real capital. That comes later after you've done a lot of proving. but they're investing their resources and their priority in you. And it's a pillar of your strategy to know how you're going to build out distribution with whom and what relationship have you developed, and then how you're going to leverage and further build those relationships. I get involved in a lot of those conversations with my investments because I used to run one of the biggest spirits companies, and I've been through the process myself. Your distributors, when they see your growth potential and they see you've got your act together, then they're going to carve out more priority to help you get there. So it's mutually reinforcing.
So when a company is getting involved and trying to figure out, how do they get their funding for the next phase, what do they have to be careful about in terms of ownership and in terms of what they're giving up through that process? Does that make sense? I mean, obviously, a piece of their business is going to be gone, so how should they structure the capital? How should they structure their businesses at that point? How much should they give up to get to that next level? Or should they be prepared to give up, I should say, to get to the next level?
We could all answer that. It's a function of the strategy. So what is the hump that you have to know what humps you've gotten over, and you have to know what's the next hump, and then what's the cost of getting to that hump with some cushion. Right. And that's how much you raise, not more, because if you raise more, then you're going to be raising unnecessary funds at a low valuation. You want to raise those funds after you've gotten over the next hump, and then the valuation gets raised, and the amount of equity you give up for that is less.
And I think the right outside investor is going to care about the balance between the new money coming in and the founder. We always want to make sure that the founder is still going to have a very, very significant chunk, is going to be highly motivated, because we've come into companies where the founder, just because he raised too much too early at the wrong valuation, gave up way too much of the company. And that concerns us, because at the end of the day, it's these one or two founders that are going to make it successful. And if they're down to 10 or 15%, that's a red flag for us.
Well, then who controls at that point, right? You want the passion of the original founders, the idea, the creativity of the original founders, correct? I mean, that's what you're looking for. And once you start sort of selling it piece by piece, you lose that control, you lose that creativity. What are the concerns at that point?
Well, I mean, it's all of a sudden the smart hedge fund guys I talked to you about that don't know anything about this industry are all of a sudden in control, instead of the founders who are really a huge part of the story behind the launch of these craft brands.
Yeah.
Go ahead, Jeff. You asked a couple of minutes ago, what are some mistakes that people make? One that we didn't touch upon, but people not investing early enough in growth. So they sort of lose momentum and not realize you have to seed it 12, 18 months in advance, all the way through the company's life cycle. I think the other one here is not understanding that financial control is different than operational control. And so I think that and it's kind of probably too much in a few minutes to kind of go through, but I would, as a founder of a spirit company, I would want to retain operating control. And what I wouldn't want somebody to do, for me, the big no would be to have somebody come in and tell me about my consumer.
Because you would know it best.
That's ideally why they invested, and that's what was demonstrated that got them to invest.
So you talk about financial versus operational control. So, there's control, right? So to what extent does financial control differ from operational control in your mind? What do you as an investor are able to leverage or to suggest or recommend or advise versus that's on the financial side versus on the operations?
Well, and an investor is really going to care about kind of 5-7 main ideas. They're going to care about the balance sheet, they're going to care about key hires, they're going to care about exit, they're going to care about having approval rights over an annual operating budget. But I don't think a sound investor is going to want to be approving marketing collateral, marketing decisions, and issues around the ingredient deck or the flavor profile. And so I think those sorts of issues that are really around the creative and the intellectual integrity of the concept ought to reside with the founders.
You agree?
So as an investor, I'm looking equal balance between how great is the idea and its potential and how great is the entrepreneur. And the entrepreneur has to just be totally obsessed and own a significant chunk and not have kind of frittered away their equity with unnecessary capital raises. piggybacking on this, I also think that, you as an entrepreneur treat every penny that you spend like it was your penny, even if it was capital that you raised, because, by being really, really, frugal and efficient and using your dollars against proving your concept, right, and getting the distributors on side with you and everything, and getting the external part of the proposition to really sing. Spend your money there. Don't spend it, on travel and hotels and your own comp. That's another thing that, that you have to be, very cheap at. And then those dollars will perform better for you, and you'll get paid because you'll own a bigger chunk of the equity of it when you finally exit. And most of that money will come to you.
I will say that the more knowledgeable the investor is in the industry, the more they're going to want to have some input into operating issues. I mean, our investment documents only have the financial controls that Jeff talked about, but we're there to try and help them with their distributor network and some of their retail go-to-market strategy. I'm sure Todd is there for there. We don't want to try and recreate aspects of the brand architecture and change the heart and soul of the company. But we are there because we know that they don't necessarily come from the industry, and we can help them as they go to market.
So one of the most important things that you develop is your board, be it a formal board, advisory board, or both. And your board is something your investors care a great deal about. Right. And your board of those are the people that you're gonna have one-on-one conversations with. It won't be around a conference table. It will be over the phone or in person. And you're gonna be saying, here's where we are. Here's what's happened since we talked last time. Here are the things that I'm really trying to figure out right now. What do you think? And your board should have a mixture of talents that you don't have. One of which needs to be, how does the three-tier system work? You should definitely get somebody like that on your board. This may sound a little self-serving. And so the higher quality your board, the better your chances of success, even though you're running the show, right? You're running the show. These are your advisors, right? And it gives confidence to your external capital that, which I hear all the time on my investments. I've got 2 investments with just killer boards, and they're like, one of the reasons we're investing here is because we love your board. And I tell them, that one of my investments board was better than my Allied Domecq board, which it is. And to investor, that's important. And to you, it should be important because you've got to figure out a lot of stuff. Right. And having this tight circle of people that have been there, done that in different parts of what you're trying to do is very valuable.
But you're going to be on the board, are you not? I mean, as
investors,
correct?
Situations I get involved in, I get on the board, and I'm a minority investor. I know my place. I'm not running the company. I'm just trying to help whoever is, the entrepreneur.
But in that case, you're bringing your experience to bear.
I hope so. Yeah. Yeah, I hope so.
I mean, I'm assuming each of you get at least a seat on the board, correct? So you're going to have some measure of advice, counsel, not necessarily control, correct? And so that you bring that to bear. So in terms of looking at these investments, since you obviously have some,
there's an unspoken control that founders have, which is it doesn't behoove an investor set to have to displace the founder, right, and tell that story at an exit, because that's failure. That's failure. That would. Yeah. So founders need to realize that there's this unspoken leverage they have, and influence over the company, and they should be. It's only a net positive to have people with expertise and other functionaries come on and kind of help them carry their vision forward.
So when you look at a company to invest in, all right, what I've heard so far is you're looking for a lot of strengths. You're looking for them to have done their homework, done the right things, et cetera. But let's take it a different way. Let's say you see a company out there that you see as sort of diamond in the rough, that maybe doesn't have its act together, and however, they have the potential to be good. So how much does that weigh on your decisions? Or do you do that at all at this point? Because then you're sort of inserting yourself more in terms of fixing up the program, and it's more than just the financial control. Now you're talking about maybe getting more involved in operational control. Yeah. What do you think about that, Bill?
You're talking about a very small company that you think may have a breakout position down the road. I think it would probably be too small for us at that point, but we would be in touch with them. We try and get them some angel investors, help them through that process, stay close, see them sort of get out of the rough and into the fairway, and then look to make a more significant investment.
Every CEO I talk to, whether they have $1 million in revenues or $20 million in revenues, every one of them admits they don't have it all under control. Nobody has it all under control. And if you think you do, then that's a problem. I went into my startup, with a lot of assets, and one of the first things I did is find Jim Reichart, who some of you may know, but he's retired now and was, one of the big guys at Seagram. I recruited him to be my advisor because I know how to do certain things in the spirits business, but his skill set with distributors was something I really needed. So he joined and was one of the key reasons why we had a successful 3 years and exited.
I think what's interesting about all three of us is we all started our own companies, and we've all made some entrepreneurial mistakes along the way. And I know from my standpoint, after 10 years of First Beverage, I can relate to the mistakes that a lot of entrepreneurs have made. Even though I'm not building a spirits brand, I've been building a financial services company. But I think it's very helpful to have that, sort of startup mindset as we advise these companies.
So you all have a great deal of experience in beverage alcohol and you're focused obviously on this particularly. How much investment money do you see coming from outside, those who don't have experience in the beverage alcohol world, and what are the pluses and minuses of that?
A lot.
Yeah.
A lot. Everybody drinks, and I haven't found investors who are teetotalers who wanted to invest in spirits, but fortunately they're in the tiny minority. But there's just a lot of folks who, especially when they look at the numbers and they go through, we've got a lot of exit data and you can see how much money's been made in spirits. They're like, well, how can we do that? And what's your strategy? And what are you going to do with my money? And et cetera, et cetera. So most of it comes from outside the spirits industry.
Okay. And then for that capital that's coming from outside, do you think there's a disadvantage to those people? They don't have the same experience you have in terms of guiding, in terms of understanding the industry, or is that something you take your money where you can get it at this point if you're trying to move up?
I like to work with people over and over again successfully. So you invest up front with those folks so that they understand the industry, they understand where the value is going to be created, what's happening to their investments, and then you do one investment, then a second investment, then a third investment.
I think it's critical to get more than just money, and to the extent that you can get true value add from an investor that's not only going to give you the right size check, but is going to help you on the operation side of your business and going to know that you're going to hit bumps in the road, they're going to be patient, they're going to understand your setbacks. I think that's critical. I think it's very, very important to get smart money that knows this industry as you're growing.
Jeff?
It goes without saying, yeah. You'd want somebody who can bring more than just capital.
So now company's developed. They've done well, right? But everybody wants to be the next Fireball, the next Tito's, right? And then they've gotten to the point where they've actually done very well. They've got a good distribution network. They understand the three-tier system after all those years now. Now they want to sell. They want to do the same type of sale that, of course, Sidney Frank, sells Grey Goose, $2 billion. They want to do that. So I know they're few and far between, but so what do they do at that point if they want to get out of this? They want to sell it out. What should they be looking for? How should they be positioning themselves? What guidance do you give at that point in the sort of cycle of the business?
I said earlier at that point, ideally, there's the transaction is meaningful enough where you could go and hire an advisor in the space, but it's not a moment in time where suddenly you start acting differently or doing something different. I mean, much of a process is really about demonstrating to people that you had forecasted there'd be 10 steps, you're at step 4, 5, 6, 7, whatever, and that should give one confidence that you'll be able to carry through and reach step 10, with or without. And that gets back to my comment where a mistake is made is sometimes not investing ahead in that growth, 12 to 18 months. What you don't want to do is go to market and have that track record, but have people looking at it and saying, they don't know what they don't know. They've reached a point where they don't have people around them, or they do, but they're not being able to exert influence, and they're going to implode under their own weight. They're growing so fast, the opportunity's so big that we don't think they'll be able to take that next step. And that makes for, a difficult process.
Okay.
And I agree with Jeff. I mean, I obviously believe it's the right time to go out and hire an advisor. I think you need to make sure your books are in order. You need to make sure you actually have your exit acquirers lined up. I think you need to make sure you can tell a compelling story about the last 12 months of growth and look forward to the next 12 months. And then I think what's very important is you have alignment on price expectations with your advisor. There's not going to be too many other gray gooses. I think the strategic suppliers are coming in earlier and earlier.
Right.
So there's not going to be a number that big, but there are going to be, Deep Eddy size numbers, and they're going to be very attractive numbers. But it's very important that you have alignment on expectations with your advisor. If you think your brand's worth $400 million and your advisor thinks it's worth 50, you've got to set that right and make sure you go out with a very cohesive message on pricing.
So my experience is, and this is pretty current with the folks that I talk to, is that once you start establishing yourself and you become a name in some space, in some geography, then you start getting the phone calls and from the strategics asking you, hey, let's get together, let's have a drink or sit down and talk. And so that evolves into, would you be interested in considering, a sale of the company? And then you have to make a personal decision and a financial decision. The personal decision is, do you want to keep running the company? Tito obviously still wants to run the company. And so he's still running it. And then the financial one is what's happened to the value curve of this? And is the next phase going to require a lot of investment and a different kind of talent than what got me to this point? And so together with your board, you make the decision whether the time is now, and then you should have professional advice who can make sure that you get the best price. And these gentlemen are well qualified to help you do that.
Right. I assume that's one of the things you do to advise them, right? You're working for your investors, obviously. You're trying to tell them when the right time is and how do they have to position themselves, correct?
Right. Have those conversations.
But I think you have to go out when you're ready, and you have to go out when the market's ready.
Right.
And I think I think what's interesting about the spirits world is there's no set marker. We're working with a very young brand right now that has had interest from 6 strategics at an incredibly young time in their life cycle. And it's the right time for them. They think they're going to have competitors coming up right behind them, and they think it's the right time to exit, and that it's a very lonely time to be a single SKU. Other brands have to wait, a lot longer for them to be assured that there's an opening in the market, and that certain suppliers have a hole in their portfolios that they can fill through their exit.
So let's talk about the market today. You mentioned the market. So when is the right time in terms of looking at the marketplace? Is it an upswing, downswing? Obviously downswing would not be a bad time, I guess. But when you're looking at the marketplace and you're trying to advise when's a good time to sell, what are you looking to see? What kind of factors are you looking at to say this is the right time for your company to make this sale? And is there any conflict between obviously your desire to make money versus now and for your investors versus their long-term potential?
I think you talk about the conflict.
I think you just as a board director, I have the board and the CEO they have to have a conversation around is the future of the company so attractive at such a reasonable amount of reinvestment cost that you should just keep going, right? Or are you at an inflection point where you really feel that there's a strategic really should take this and go forward. And even if you were in the middle of that, you said, yeah, probably, you'd still could have some conversations and find out if any strategics were really interested in anything near a number that you'd be attracted by. And you would do that and then make a decision, yep, I'm going to do it, and now's the time. So it's not binary, it's iterative.
And I don't think, it doesn't serve the investor or the investment bank well to go out when you're not going to have a frothy auction process. Right. It's a worse thing for an investment bank because you spend months and then don't have a successful result. So I think that's, I think it's all about timing, and there has to be alignment
go out on the way up.
Right. Always, but where on that curve is the question, right?
That's the judgment that you have to make with your directors. And if you choose to engage an advisor because you're already into very big numbers, right, that it makes sense to engage an advisor, then you should do that.
And I think it requires a lot of conversations with the potential acquirers to know what they're looking at month by month. And then I think it requires a lot of sector analysis, what's going on within that exact segment, and see if this brand is going to be a breakout within that segment at this particular point in time.
I reached a decision on Docourt Martin Imports, which is X-rated and Jean Marc XO, that the Campari deal that was on the table was something that we should take. They doubled the size of the business within approximately 12 months or so, and I said, great. So they're happy, I'm happy, let's go see what's next. And that's the ideal experience, that they should be successful and feel good about it and have an earn-out, which is what we had, and got paid for part of their success.
Jeff?
I was just going to say, our philosophy as a firm has always been to kind of reflect our buy-side origin. So we think more like a principal than an advisor. We'll find a concept, whether it's Old Smoky Moonshine, Skinny Girl, Redemption. We find them very early. And our average client relationship as a result is about 4.5 years. And as I'm listening to this, I'm thinking, one of the mistakes somebody would make would be by reaching out and finding an advisor at the point where they're starting to think of an exit, because it's really, you want that advice sort of, throughout the company's life cycle, in part to remove the conflict. Like, we don't have a retainer, our fees are always success fee based, and year 3 doesn't matter from year 7 to us. But you want to have, to me, this question about when be more of an inward-looking exercise than an outward-looking. Like, I'm not going to be too worried about the market in the sense that I have a belief that I have something really special. It's a gem, right, and people will continue to prize it because it whether it's adjacent or in a new category, it's staked out a leadership position that is relevant and important and is continuing to grow. And others will want to own a piece of it somehow, some way. So I think it gets back to just sort of knowing the concepts or the brands that are really the gems and the winners.
So looking at the world today, and you're looking at, let's talk. You talked about Campari buying out your brand, obviously, but yeah, looking at some of the bigger spirits suppliers out there today. At what point in time are they looking to purchase some of these other brands? At the very genesis, the very early stage, or the mid stage? Obviously, the Bacardi, the Grey Goose deal was well advanced in the stage of Grey Goose. So at what stage of a spirit supplier are they looking to buy now? Are they looking for something early on? They see something good and they want to take the investment early on, or is it sort of in the sort of medium or developed stage at that point? What are they really looking for?
I'd actually answer it in the other way. I think they want to make sure that these are brands that can be 500,000 case brands at the end of the way. And so they may actually dip in very early in a 2-stage type transaction like the one we talked about, where the brand may only be 30 or 40,000 cases. But I think the more and more suppliers I talk to, they want to know that these brands can be breakthrough brands because their systems are so large that it's very hard for them to be able to give a smaller brand a lot of the attention unless they think that small brand can get very significant in their system over a relatively short amount of time.
Okay. So they're obviously looking for that value. You talked about earlier, though, about the fact that sometimes they're going to give them seed money. So when would they give seed money? When would they want to buy outright? Is there a defining line there?
Sorry, my allergies have been a problem. Usually, once the concept is proven, they want to buy out earlier as opposed to later. So if they could buy out at 50,000 cases and they can see it going to 500,000 cases, it's cheaper for them to buy at 50. And that's why you start getting phone calls earlier in the cycle. But they're only interested in buying things that are going to be 500.
That's the number. That's the golden number. So the companies that are looking for that buyout have got to be able to ultimately get to that point, to scale up to that point.
It depends on the category.
I think I personally would rather talk about like a margin pool or something. Because at the end of the day, the big suppliers, they're looking at their core brands or their power brands, and they're defining them as having a certain threshold above a number.
Okay.
And that's, I think with this trend in premiumization and FOBs changing, and you could have a 200,000 case brand, a $65 American whiskey brand that could be more relevant than a 500,000 case brand in another sector. So it's really, I'd quantify it in a financial sense. A
craft whiskey or a liqueur would be very meaningful at 100,000 cases. It'd be fantastic at 100,000 cases. Saint-Germain, Canton, and then there's Redemption, of course, sold at much less than that. So so it depends on the category. So if the category is high margin, premium or ultra premium, then lower case volumes would work. If it's Deep Eddy or it's something that's in the vodka space, 100,000 cases isn't much. It needs to be a lot bigger.
Yeah.
So we're almost running out of time here, but you say right now it seems like a very good time for investment, for innovation, for growth. Do you see anything happening in the next few years, or how long do you see this going on, this upward curve that we're seeing right now? How long do you think it'll last? Jeff?
I'm putting my time and energy into this space with a sort of a 5 to 10 year horizon in mind.
Okay.
I think the demographics are incredibly positive for the alcoholic beverage industry and spirits in particular. And because the millennials and the Xers are such a huge generation, and they're entering their prime earning years and moving into cocktails and driving craft and so forth. So they're going to be around, and drinking. I've got 4 of them, and 2 daughters and their husbands. And they're all out there, and so that's going to stay for some period of time, 5 to 10 years, and maybe longer. The wild card in this is recession, shock. If there's an economic crisis, then there'll be a short-term hit from that. But then as you come out of it, then it keeps going.
Yeah, I completely agree. I think this is a seismic shift to local, organic, artisanal, authentic craft. And I think what's hard for the bigger suppliers, it's also a shift away from corporate and mainstream. And I don't see it going away. I think it's going to be much longer than 5 to 10 years. I think it's a great beginning era of small brands. And I also think social media is a huge driver. You're going to tweet about this small craft spirit that you found at a great restaurant in Chicago or Venice, California. You're not going to tweet about that bigger mainstream brand that you discovered at a Costco. And so I think this is really the early innings of a great period for small brands.
Well, let's hope so. But thank you all for your time. Really appreciate it. Great conversation. Thank you very much.